So stock markets are at all-time highs again, particularly in the US. The last 5 years have seen fantastic returns. Nvidia's on an absolute tear. So today I want to do a video on how to get started in investing in the stock market. Stay tuned to the end of the video where I'm going to talk about one of the hidden fees that is very common, particularly if you're buying overseas shares, okay? So stick around till then and I'll tell you about the fee and you need to watch out for this. Hi, I'm Jeff. I've been working in the financial markets for around 20 years now, and I've set up this channel and publishing these videos to try and pass off some of the knowledge I've gained over that time period. I'm also a keen saver and investor, and I want to pass off everything I've learned over the last 20 years or so in the financial markets and my savings journey to you to help you get started and achieve your goals. By the way, this is not financial advice. I do these videos just for education and information purposes only. If you need advice, then seek out a qualified financial advisor. Now let's get into the video. Okay, a couple of things you need to know before you get into investing in the stock market. For one, you want to make sure that all of your debts, credit card debts, things like that, high interest paying debts, you want to make sure that you've got them covered before you put money into the stock market. Another thing, you want to make sure you have your rainy day fund sorted. And what I mean by that is you want to have an account, a savings account typically, where you've got 6 to 12 months of your living expenses put in that account for a rainy day. Also worth knowing, if this is money that you think you might need in the next 5 years for anything, then it probably shouldn't be in the stock market. It's just too volatile. The last thing you want is the market sells off 20-30%, which it's prone to do sometimes, and you need that money, which would mean you're selling at the worst possible time. So if you have your debts paid off, you've got a rainy day fund, it's money that you think you won't need in the next 5 years, then yes, let's look at getting invested into the stock market. So what are stocks and shares? You hear the term all the time, but really the two are used interchangeably. A share is really just a part ownership in a company. That's right. So a company will take those shares and list them on a stock exchange when they need some financing to finance some projects, some investments, some things they want to do to grow their business. And that will happen through an initial public offering known as an IPO. They'll seek out investors who will invest in the company if they like what they see, and then the shares will get listed on a stock exchange. And once that happens, people like you and I can start buying and selling these shares. The shares trade on a stock exchange, and depending on the size of the company, they'll be part of an index. An index like, say, the Standard & Poor's 500, also known as the S&P 500. And that are the shares of the 500 largest companies in the US. In the UK, it's typically the FTSE 100, the 100 largest companies that are traded in London. But if it's a smaller company, it may be a member of, say, the Russell 2000 index, and that's 2,000 small cap companies. By cap, I just mean the size of the company, the market valuation. So shares trade on an exchange, and they're typically part of an index. So if you want to invest in the stock market, the most common way to do this is through buying individual shares. And this, like I said before, is really just buying a share ownership in the company. To do this, well, you've got to do some research to decide which company shares you wish to purchase. And research comes in two ways typically: fundamental analysis and technical analysis. Fundamental analysis is where you review the kind of fundamentals or the operating numbers of a company. Things like sales growth, earnings per share, operating margins, how much debt they have. All of this stuff you will want to do a lot of research on and work out whether this is a company that you feel you wish to be an owner of. Technical analysis, on the other hand, is typically more for short-term trading. And that's where you would look at a chart of a price of a company over a particular time period. And then you try and identify patterns and work out a good time to buy and sell. This is a little bit more of an active trading sort of strategy versus the fundamental analysis I mentioned earlier. A lot of people make the mistake of buying shares based on price alone. They see that it was trading at 100 before and now it's trading at 75, so it must be a good deal, right? And that's certainly not always the case. There could be a very reason why the share price is sold off. So you want to understand the fundamentals of the business before you go ahead and invest directly in shares. Now, if you're not ready to do all of that and understand enough about buying shares directly, you can also do so through a fund. There are a couple of different types of fund. The most common over the last 30-40 years is a mutual fund. And with that, you'll have a professional investor who will take that money, that pool of money in his or her fund, and they will go and do research on these companies, the fundamental analysis I mentioned earlier, and decide which companies they want as part of their fund. What they're really trying to do here is find the companies that they think have the best prospects over the next 5 or 10 years that will outperform the index. So of the S&P 500, 500, for example, a professional fund manager of a mutual fund will try and find the 30, 40, or 50 companies that they think will give a better return than the S&P 500, and they'll buy shares in those companies on your behalf. A couple of things to know about buying mutual funds. They're a lot more expensive typically than just buying a passive fund. And then also over a 5 or 10-year period, it's very difficult to outperform the benchmark. And a lot of mutual funds underperform the benchmark themselves. So you're really not getting what you're paying for with that additional fee. But if you want to go ahead, you like a particular fund manager, you think they're going to do a good job of picking the right companies, then go ahead and buy a mutual fund as you wish. You can find them by sector, by industry, for example, emerging market funds that are maybe overseas. There's all sorts of mutual funds, literally thousands of them. But do your research and make sure it's a good fund at a fair price for you. Another type of fund is called an exchange traded fund. And with this, the fund actually trades on a stock exchange, just like a company stock does. So it's very easy to buy. You just open up an account and you can buy certain number of units in the exchange traded fund. So a simple example would be an exchange traded fund that tracks an index like the NASDAQ 100, let's say. And if you buy that fund, just one transaction, then your money will get divided up in the 100 largest companies on the NASDAQ. Okay, the market return you will get will be the same return of the NASDAQ 100. So this is a very cost-effective way to get an exposure of an underlying index. Because you're not employing a professional fund manager to actively research and try and outperform the market, you're just taking the market return. These are more competitively priced and you can buy them for a lot less than, say, paying a professional mutual fund manager. And if many professional mutual fund managers struggle to outperform the market over a long term, then perhaps you could look at buying an ETF in an index and just take that return for cheaper. This is known as passive investing because you're passively taking the market return. You're not actively trying to outperform. So a mutual fund that's trying to outperform that index is considered an active form of investing. By the way, if you want to pick your individual shares, that's a form of actively investing. You're an active investor who's trying to outperform the market. There's been a real shift to passive investing recently because the returns have been fantastic. Some of the major indices have returned, 10, 12% compound annually over the last few years. So a lot of people have just been happy to buy the S&P 500 or the NASDAQ 100, for example. Investment trusts are another type of fund. They're actually listed on a stock exchange as well. They're more typical on the London Stock Exchange. And with an investment trust, it's typically just like a professional fund manager, like a mutual fund, but rather than be a mutual fund and not traded on the exchange, these you can buy on the exchange. And the fund manager is trying to do the same thing, actively outperform the underlying index. There's investment trusts for all sorts of sectors and industries and strategies as well. So do some research if you're interested in getting a professional to manage your money and you just want to purchase the investment trust on the stock exchange. So how do you go about buying individual shares or an exchange traded fund or a mutual fund? Well, generally you can just set up an online brokerage account. By doing so, they're quick and easy to set up. There's many different types of forms, apps, everything you can do to get an account up and running. And the one thing that you want to know with this is it's typically an execution-only service. In other words, they're just helping you execute the trade that you want to do. Another form of investing is using a financial advisor, and this is an advisory type of service. The fees will be higher, but they will sit down with you, talk about your risk profile, your goals and objectives, and then they will advise you or recommend certain funds or shares to buy. This is a lot more expensive and they don't always outperform the underlying index. So you want to tread carefully here. If you want a financial advisor, make sure you do your due diligence and you're happy with what you're getting and the fees that you'd be paying for. In my opinion, personally, I think it's just easier to buy an exchange traded fund on an underlying index like the S&P or the NASDAQ and go with that over the long term. It's the easiest way to invest in the stock market. But ultimately, this decision is up to you. As you may have seen in some of my other videos, I use this strategy. I just buy around 90% of my portfolio is in an S&P 500 ETF. And that's it. I just take the market return. Or the other 10% just sits in cash. Or sometimes if I see an opportunity or something that I really like, then maybe I'll buy an individual share or another ETF. But generally, I have a rule where I keep about 90% in the S&P 500. Sometimes if I think the market's looking really high, I might sell a little bit and move that percentage down to 80, for example. And other times when the market has sold off a lot, I may just put that 10% cash back into the S&P 500 and be 100% invested. It's all in what you're comfortable with. So when you set up a brokerage account, one thing that you really want to take advantage of are tax-free savings accounts. There's different types depending on the country you're in. So in the UK, for example, you can set up a stocks and shares ISA. It doesn't have to be a cash ISA. You can buy stocks and shares and ETFs and things in an ISA account. In the US, you're looking at things like a Roth RIA, or in Canada, a tax-free savings account. The benefit to all of this is in the future, when you have gains, profits, capital gains on your investments, when you want to sell them, you won't have to pay any tax on it. Also, if you get any dividends, and dividends are just a form of income depending on the share or the fund that you purchased, some will pay you money just for being a shareholder. Well, those dividends are tax-free as well. So look at, in your country, the tax advantage accounts that you can open to invest in the stock market. It's a big deal to do this and do this where you can save on taxes. I mentioned dividends a moment ago. There's a couple of types of investors as well that you should know. Dividend and growth. Okay, dividends is where, like I said, you buy a company share and they will pay you cash just for being a shareholder. So what they're doing is they're taking their profits and a percentage of that they decide to pay out to their shareholders in the form of a dividend. And your broker will just deposit this into your account. If you do receive dividends, it's very wise to get dividend reinvestment. You should turn this on, this feature with your broker, and therefore when you get a dividend, they will reinvest it for you back into your chosen fund or share. This is a great way to get compound returns and really adds to the returns of your investments in the stock market. A growth investor, on the other hand, is not fussed about dividends at all. They really want to see a company grow their sales, grow their profits, and ultimately their share price should grow along with that because that's how it works. Growth investing can be a little bit riskier because, well, these companies tend to have higher growth rates, but they may not make it. Typically, they're not as proven as some of the companies that have been around for a while, have big profits and pay dividends. But you can find something in between. Apple, Microsoft, they pay a little bit of a dividend, but Amazon, for example, doesn't. Why? They want to use that money instead of giving it back to shareholders. They think it's smarter to reinvest that money in new projects that will give them more revenues, more profits down the road. And this can be a very smart way for them to compound their returns as well. So in my opinion, as an investor, you shouldn't worry too much about dividends. You worry more about the returns and the profits. If it's a good company and they're reinvesting those profits at a higher rate of return, then the share price will be reflected in that. So when you set up an account at a broker, there's usually a couple of different fees that you need to be aware of. The main one is the commission fee. So when you purchase a share in ETF, they're typically going to charge you a fee. That can be done in percentage terms or that can be done as a flat fee. So shop around and make sure you get the best deal for you. In addition to commissions, there's other fees like platform fee or sometimes a custody fee. And that's just a fee for having access to the platform. Platform fee is more typical if you don't own any stocks or shares or funds in your account. You're just holding cash or nothing at all. They may charge you a quarterly or a monthly fee just to have access to the platform and all of the tools that they provide. A custody fee is more typical when you're holding a stock or a fund, and the broker that's giving you that fund are holding that in custody on your behalf. So they're going to charge you a fee for that. So shop around and make sure you're getting the best possible rates because, again, lower costs are far better when it comes to long-term investing. Now, I mentioned earlier another fee that's really important that often gets overlooked, and it's usually pretty high. And this is an FX conversion fee. This is particularly relevant if you're buying shares or funds in markets that are not your base currency. So, for example, I live in London, I sit in London. If I were to have a pound sterling brokerage account, but then go on to buy US stocks or funds, there would be a conversion of my money from pounds into dollars. And then when I sold those shares or funds, the dollars that I would receive for selling them would come back in pounds. Again, there would be a conversion there from one currency to the other. It's not uncommon for brokers to charge around 1% for this currency conversion. That's right, that's a lot. So they may advertise free commissions or a very low commission fee. But when you go and place and trade in shares or in funds that are not in the same currency as your base currency, they're going to make money by taking around 1% of the total value, and this can add up a lot. So make sure you find a provider with a low FX conversion fee, particularly if you're going to be doing overseas investments. When you start investing in the stock market, there'll be a lot of emotions that come with that. The news headlines, the economy, the market going to crash, recession. It'll always be kind of a negative sort of message that's around there. But here's my advice to you. Just get started. Buy index funds to get started, ETFs, start small, get a little bit of money in the market, dip your toe in the market, and get comfortable with the movement and the feeling of having some of your money in the stock market. Another trap that I see people fall into is they want to do some virtual or demo trading first. And I can tell you right now, you will learn so much more by just having a little bit of money in the market than you will do by demo trading big amounts that is just, not even real funds. You could do that for months and years and really not learn that much. You really need to get a feel of just having a little bit of money in the market. The stock market can be volatile. It can move a lot. There's no question about it, but you can use this to your advantage as well. So how do you do that? Well, rather than put in a lump sum of money all in one go, as I've said many times on this channel, automatic investments are a great way to reduce that volatility risk of stock investing. Just set up a direct debit or automatic transfer. So every month you've got money going into your brokerage account that then goes into index funds or the shares of your choice. That way, when the market is high, like it is now, you'll be buying less units. And when the market is low, because it's sold off a lot, you'll be buying more for the same amount of money. This is a great way to reduce the risk. So that's really it. That's how you get invested into the stock market. Get yourself a brokerage account, get it set up, do some automatic transfers, start doing some research on individual shares if you wish to do that, or index funds and ETFs like S&P 500, NASDAQ, FTSE 100. That is a great way to reduce your risk by using index funds instead. Start off with that. But if you're really kind of interested to do individual shares, there's a company that you really like, then go for it. But my suggestion is you put no more than 5 to 10% of your portfolio into individual share picking. At least get some experience first of being in the market before you look at that. And if so, just keep it to 5 or 10%. Well, that's my video on an introduction and how to get started in the stock market. If you like the video, why not subscribe? I've got some more great videos coming in the pipeline. Give it a like, and why not share it with a friend who you think would benefit from this? Stock market investing can be an excellent way to build your wealth. It's certainly been good to me, but you've got to understand some of the fundamentals and not make some of these big mistakes that people make, like panic selling when the market is sold off. But get started, a small amount, and get yourself into the market a little bit and get that feeling of the emotions of doing that. And I wish you all the best with it, and I'll see you the next one.